Aman Chowhan joins us, and it's taken us quite a bit of convincing this time because every time small and mid-cap stocks they go down, he refuses to reply to my messages. He does not take a call, but looks like small and mid-cap stocks have stabilized because Aman is back on the screen. It is not a good reputation to have, right?
They have not yet stabilized. Only few of them have.
The ones in your portfolio have they stabilized? That is what matters.
In that also, few of them have, not all.
Okay, let's understand what is the way forward for small and mid-cap stocks, and I'll break it into 2 or 3 points here. First, for the mid and the small cap stocks as a cycle. Second, where are they headed in terms of a where are they headed in terms of a theme, and see when will the momentum really come back in some of these stocks.
First thing is, see, there is always this assumption that it is large cap versus mid caps. Normally, it doesn't happen that way. At any given point of time, there will be some large cap that will do well, some mid cap that will do well, irrespective of the cycle. Now, currently, we had good 3.5 years of mid and small cap outperformance, and we are giving away some of that outperformance. That too, only those stocks which had gone to 50-60p have corrected the maximum, right? So it's not that overall as a basket, mid and small cap has corrected. Yes, there is some technical factor, liquidity factor, retail investment or interest was maximum in this space, which is obvious, and hence that is where the maximum selling is. Because as far as institutions are concerned, us or whatever whomever I have spoken to, there has been no redemption in the MF or in the PMS AI space. So it's predominantly retail that has been selling, and that's where the maximum interest was, and that's the reason we have seen a sharp correction in mid and small caps. Going ahead, I think the whole market is waiting now for the numbers to pick up. There has been some pickup, whether in GDP numbers, in earnings growth, or in top line or something, for it to get some trigger or some reason to be bullish about, or to add on to what the current holding is. So that's what the whole situation is. Mid and small cap will start to do well once you see the numbers coming in. There are some sectors, companies where numbers are still strong. Maybe the P went up too high, which is now corrected, and it will stabilize at current levels. And overall, once the market starts to see some momentum, these stocks will also perform in that. So it's not a large cap versus mid caps. Within mid caps and within large caps, wherever we see earnings visibility, those stocks will outperform for sure.
Have schemes, and especially Abacus Emerging Market Opportunity, where the tilt is more towards semi-large cap and mid cap and few small cap. Where are these mid-cap dominated schemes headed? And for those who have a exposure, direct exposure or indirect exposure via PMS or via mutual funds in small and mid-cap stocks, what should they do now? Just bear the pain, move to large cap, or perhaps add more to the current commitment?
I think bear the pain, add to it over the next 6 months, nothing in a hurry. And then maybe the 6 months is the consolidation phase or time correction or whatever word we use for it. It's time to put capital to use, and you'll reap the benefits of that capital maybe in the next 6 months. Once dust settles globally, what Trump wants to do and what retaliation other governments or countries will do. And at India also, whatever measure the government has taken, both for the consumption as well as the capex, starts getting reflected, and we see a pickup in the GDP numbers and the earnings growth numbers, is when the markets will again start to give you a healthy return.
Sure. So, Aman, very realistically, what should be the index return expectation for this year, both on the Nifty as well as the mid and small caps?
Can be flattish to maybe 5-10% up and down, not more than that. Either ways.
Right. That's the other thing, Aman. One is wondering how soon before the pain gets resurrected, and more importantly, whether or not you will have to live with this kind of gut-wrenching volatility on a daily basis for the next foreseeable future.
I think volatility is going to stay because there is uncertainty both locally as well as globally. Earlier, there was volatility globally, but locally we were doing strong. Now that is not the case. So when there's uncertainty, this is something that the markets don't like at all. And hence, right now, even the momentum or confidence or sentiment, everything is weak. So the volatility is going to stay. It can get worse before it gets better. That's what the scenario is, because we all know markets worse. Market is extreme on both sides, when it's rising and when it is falling. So we are somewhere midway right now. It's not that we have seen the bottom or the worst is over kind of thing. At the same time, we have seen a decent correction. So it's not that we are going to fall another 30-40% from here on. Maybe 5-10% from current levels is possible in the near term before we start to recover.
10% Aman on the Nifty?
Overall, yeah.
Okay.
Nifty could be less because, see, within the Nifty, banking is the highest overweight, where this whole segment is looking good. That segment has not performed for the last 2 years. There's not much of a downside there. IT will continue to do well because of the currency. Pharma, we have seen, in spite of whatever the tariff news today, stocks are just down 2-3%. Maybe in a week, 10 days time, they'll recover that also. So the heavyweights, consumers, because of the budget and the measures the government have taken, there's not much of a downside. The Nifty might not, but the broad index or broad stocks can further credit 15%.
That may be a very tactical approach, but if one has to look at the recent correction that's played out and, sort of rework your portfolio or assume someone's making their portfolio afresh, what kind of an allocation would you recommend to them, both market cap wise and, of course, any stocks or sector selection?
It's more to do with the person as to what kind of risk appetite he has, what kind of time horizon he has. But broadly, it will be very popular to say that stick to large caps, it's volatile times, and hence this is the best way to go in. Yes, it is. But if somebody has a 3 to 4 year view, then at least 50-50 should be the allocation between mid caps and large caps, because ultimately Indian equity market is all about mid caps. This is where the maximum opportunity is. We all know the large cap, we all know this company, good company, but it'll give you a normal return. If you need to generate an alpha, you need to look at mid market. Right? You need not go to a small or a micro cap, but at least mid cap should be in the portfolio, because that's where the entrepreneurial spirit and the growth potential of India lies.
You say that, Aman. And since one talks about mid and small caps, I think the one place where people have really burnt their fingers, assuming, of course, on when their entry point was, is in the entire PSU pack. And we were just taking stock that from the 52-week highs, sectorally, it's the PSE index which has fallen a lot more. And top of your mind comes those defense and railway names. I think that's where the first signs of a correction actually crept in firstly. What's your thought on that? And would you have any of the defense and railways names in your portfolio at all?
In the 6 months back, PSUs, defense and railways were the best performing sectors. That is where the maximum rally was, and stocks had re-rated to north of 60-70p. And that is where the maximum correction has happened, or the P correction has happened, and another 70p is now at 40p. We did not participate a year back. We had no defense stocks a year back also, so we missed on the rally. Nor have we yet got into those defense, because the 70p has come down to 40p. 40 is still not an entry P for us. If it comes down further, maybe we'll look at it, but not at these levels. So we never participated in the upside, nor have we got burned in the downside that we have seen in the last few months. Overall, as a sector, we like it because the macro positives, there's a clear government focus on what these companies are intending to do, and the government wants to cut the import bill, which is very clear. But valuation is what the concern is, because ultimately these are government policies dependent companies. Government decides what to buy, when to buy, what margins, how to pay, when to pay, and so forth. For these kind of dependent companies on government, you cannot have a 30, 40, 50p, which market was paying because it was seeing growth, which is true. Yeah, they will not trade at 5-10p the way it used to trade 5 years back, but maybe somewhere around 20-25p would be the right multiple for this sectors.
All right, but Aman, what's your take on the railway pack as well? Because what we have seen is that it's a sharper correction there, almost a 40 to 50% decline from those 52-week high, and a lot of retail investors have a feeling of getting stuck there. Do you believe that once again it's time to look at that particular sector after the valuation correction, or time to stay away still?
I think it's time to stay vested, because as I mentioned, 80p has become 60p or 50p, which is still not an entry P. So, and we don't have it, there is no hurry, at least in our mind, to look at them at the current value.
Market, what is something which has corrected where you said that, look, I like the business, I wanted to buy the business, I was not very happy with the valuations. The correction could have happened because of technical factors, it could have happened because of liquidity issues. But what is that one pocket name or theme which you thought at the beginning of the year, I will buy it if I get them 20% cheaper?
Capital goods for sure have corrected 30-35%. That is looking good, except the top, the MNC names, which are like 50-60p. Otherwise, they are now at 25-30p. This is where the momentum right now is. That segment is looking good. Even mid cap IT, the large cap IT is not corrected, but mid cap IT has, or mid or small cap IT has. That segment is also looking good. EPC companies, they are all corrected 30-35%. And now trade at 10, 11, 12 times forward earnings, which is a very good entry multiple for this segment because the government spending is now picking up post the elections and post whatever we saw over the last few months. Now clearly the budget allocation is there that the government is going to spend. So the order book positioning of these companies is going to swell, plus at 12 times, it's a good segment to look at. So these would be the three segments that has caught our attention, and we have started nibbling at these names now.
1 year, what are the fundamental changes you've done in your portfolio? For example, same time last year or maybe 18 months ago, you did have exposure to, let's say, railway stocks, Texmaco. I'm looking at your declared portfolio. That's out. What are the big changes which you've done in your portfolio because of valuations or because of the economic turn?
So we have cash in our portfolio. This is not a cash call that we do because we don't do that, but whoever has come to us in the last 6 months, that portfolio has been 70-80% deployed. So we were gradual and cautious in deploying any new inflows that we got. So we have those cash holdings now, which we are now going to deploy over the next, say, maybe 2 to 3 months kind of scenario. Sectorally, we have added more of financials, we have added more of pharma, we have added bit of metals a few months back. Within consumers, we don't have much of consumer exposure, but post the recent correction of budget measures, everything, there is a bias towards getting into consumer discretionary. We are still not convinced to get into consumer staples, but discretionary is something that we are now actively looking at. Maybe we'll add some exposure there. So there has been some sectoral shift in that sense. So you'll see more of consumer in our portfolio versus say 2 years back. PSUs was never there. That's not going to be the case. IT could be higher. It was single digit, high single digit a year back. It could get into mid-teens kind of levels in the next few months. So these are some of the sectoral changes that we have taken at the macro level for the portfolio.
All right, and Aman, since you just talked about the pharma space, within that, any particular segment that you like at this point in time? And I also wanted to have your take on the whole of the announcements related to Donald Trump making the headlines and trying to, and also saying that there could be a 25% tariff imposition for the pharma imports. What's your sense on that? Is this situation likely to occur, or you believe that given the large exposure of the Indian pharma players, that could be a little tough task to go ahead and implement?
Very difficult to say because we all don't know the announcement that Trump is making. What is that real intention? Whether he wants to negotiate or he really wants to do it. He's a businessman first, politician later. That's what I personally feel. So if you're putting tariffs, you're importing inflation. Everything gets expensive. This is not consumers are going to like, right? So I'm sure he has something else in his mind also. It's not just going to be a blanket 25% tariff across the board because it's not going to be easy that everything then gets manufactured in US. It doesn't happen overnight. Broadly, what he is doing is something that we are also doing in India. What Modi is, make in India, Atmanirbhar Bharat and everything. That's what they also want to do, but it doesn't happen overnight. And if you have a tariff overnight, then it's going to be a disruption in the near term. So we also don't know exactly what's going to happen. And also, more importantly, we are seeing only one side of the coin as to what Trump is doing. We also need to see as to how people retaliate. If there's a 25% tariff and he signs that order and that's going to be the law of the order, then the exporting country will also do some measures, maybe devalue the currency, maybe he'll have a counter tariff or something. That's also going to be equally painful, right? So right now the whole focus is only Donald Trump. We also need to see that how others retaliate. And that's the reason I said in the near term, things will be volatile because it's not just Trump. how people act to it is also going to add to the volatility in the near term.
All right, Aman, with this, we'll let you go on that. Really appreciate you taking the time out and speaking with us. Good chatting with you. But